Good morning, afternoon, or evening, everyone. Today, I will be discussing the impact of tariffs on inflation, the stock market, and investment strategies. We will explore what tariffs are, how they influence economic conditions, and most importantly, how investors can navigate trade wars effectively. Let's get started. The information provided in this video is for educational and informational purposes only, and should not be considered financial or investment advice. Investing in the stock market involves risk, including the potential loss of principal. Always do your own research and consult with a financial advisor before making any investment decisions. To begin, let's define tariffs. A tariff is a tax imposed on imported or exported goods. Governments use tariffs to make foreign products more expensive, encouraging consumers to buy domestic goods instead. While this sounds beneficial for local businesses, it often leads to higher prices for consumers and economic disruptions. Now, why do governments impose tariffs? Some of the key reasons include protecting domestic industries, generating revenue, reducing trade deficits, and retaliating against unfair trade practices. Additionally, tariffs can be used to encourage local job creation, protect national security, prevent dumping, and address environmental concerns. However, despite these intentions, tariffs often have unintended economic consequences, which we will discuss next. One of the biggest consequences of tariffs is inflation. When tariffs increase the cost of imports, businesses must either absorb the cost, reducing profits, or pass it on to consumers, which leads to higher prices. Additionally, domestic companies may also raise prices because competition from imports weakens. This inflationary pressure can be worsened by supply chain disruptions and shortages, further driving up costs. To combat inflation, central banks like the Federal Reserve may raise interest rates, making borrowing more expensive and slowing economic growth. Now let's talk about the impact of tariffs on the stock market. Trade wars create uncertainty, which leads to increased market volatility. Higher costs reduce corporate profits, particularly in industries that depend on imported materials, like manufacturing and technology. Inflation caused by tariffs may also trigger interest rate hikes, putting further pressure on stock valuations. Additionally, a stronger U.S. dollar, often a result of tariffs, can hurt American exports, making U.S. products more expensive overseas and reducing global demand. Given the risks associated with tariffs and trade wars, what can investors do to protect their portfolios? One effective strategy is to invest in defensive sectors like consumer staples, healthcare, and utilities, which tend to perform well regardless of economic conditions. Focusing on domestic companies that are less dependent on global trade can also minimize exposure to tariff-related risks. Additionally, investors can hedge against volatility using safe haven assets such as gold, bonds, and cash alternatives. Let's take a closer look at defensive stocks and ETFs. Consumer staples, utilities, and healthcare stocks tend to remain stable during economic uncertainty. Some key investment options include ETFs like Vanguard Consumer Staples ETF, VDC, which includes companies like Procter & Gamble, Coca-Cola, and Walmart, and Utilities Select Sector ETF, XLU, which includes Duke Energy and NextEra Energy. These sectors provide essential services that consumers continue to use even during economic downturns. In times of uncertainty, investors often turn to safe haven assets and hedging strategies. Gold, represented by ETFs like GLD, is a traditional store of value during market downturns. Treasury bonds, such as those tracked by the TLT ETF, offer a safe, fixed income alternative. Additionally, cash equivalents like short-term Treasury ETFs, SHV, provide liquidity and capital preservation. For those looking to hedge against market volatility, instruments like the VXX Volatility ETF or inverse ETFs like SDS can help protect portfolios from downside risks. To wrap up, let's review the key takeaways. Tariffs lead to higher import costs, which contribute to inflation, interest rate hikes, and stock market volatility. Defensive sectors like healthcare and consumer staples provide stability, while gold and bonds serve as hedging tools. Investors should consider diversifying their portfolios to minimize exposure to trade war risks. Lastly, identifying opportunistic investments in industries that benefit from trade disruptions can create profitable opportunities. Thank you for your time. I hope this presentation has provided valuable insights into tariffs and their impact on the economy and investments. I'd be happy to take any questions you may have.